All right, let's just cut right to the chase. Do you ever feel totally burned out trying to chew through those dry 60-page earnings call transcripts? Yeah, me too. Well, don't sweat it, because today in under 10 minutes, I'm going to save you a full 2 hours of tedious reading. We are doing a deep dive into Corning, and we're going to unpack exactly how they've quietly positioned themselves as the ultimate hidden powerhouse behind this massive AI infrastructure boom.
We aren't just going to rattle off a boring spreadsheet of numbers today. Instead, we're going straight to the core investment logic. We're going to completely decode the hidden drivers behind Corning's unprecedented spike in quarterly performance. And I can guarantee you, the high-level industry insights we are about to get into, you simply are not going to find these in your standard daily news reports. You ready?
So here is our roadmap for this explainer. First, that Q1 financial blowout. Second, the absolute explosion in their AI optical network business. Third, the aggressive solar supply shift. Fourth, we'll hit the Wall Street Q&A highlights. And finally, we'll wrap up with the future outlook and objective risks. Let's get into it.
Part 1. Q1 Financial Blowout. Crushing the guidance.
Honestly, this was a comprehensive, across-the-board victory. Corning didn't just meet expectations this quarter, they absolutely crushed their own high-end targets. We're talking $4.35 billion in core revenue, which is an 18% bump year over year. But the number that really jumps out is the core earnings per share, hitting exactly 70 cents. To put that into perspective, that is a massive 30% jump from last year. It just perfectly demonstrates the incredible operating leverage Corning is wielding right now. And when you break down the metrics, you can see exactly how they did it. They generated $188 million in free cash flow, and profit margins expanded everywhere. Their operating margin grew by 220 basis points, that's 2.2%, to hit 20.2%. Gross margins were up 120 basis points, and the return on invested capital, basically how well they use their money to make more money, surged to 13.5%. Simply put, Corning is running as a highly efficient profit machine right now.
Moving to Part 2. AI Optical Network Explosion, the secret sauce.
This is the main event. Everyone talks about AI, right? But Corning is actually turning AI hype into cold, hard cash. CEO Wendell is running a brilliant, high-level strategy here, focused on what he calls the total installed cost. Think about it. A traditional company sees demand spike and they just aggressively hike up the price of raw materials like bare optical fiber. Not Corning. They provide innovative solutions that save these massive tech giants an absolute fortune on back-end deployment costs. And because they save their customers so much money on the back end, Corning can comfortably charge a premium for their products up front. It's a total win-win profit-sharing mechanism.
And the climax of this strategy is just wild. The Optical Communications division saw revenue grow a really impressive 36% to $1.8 billion. But wait for it, net income skyrocketed by 93%. They hit $387 million in net income. That proves the profit margins on these innovative new AI infrastructure products are just astonishing.
Okay, right before we look at the massive contracts locking in this explosive growth, I want to say, if you want to stay updated on the latest US stock market news, make sure to subscribe to my channel. I upload new explainers every week.
All right, let's get back to how Corning is securing the bag here. The demand is almost unimaginable. You probably remember they recently signed that massive $6 billion long-term contract with Meta. Well, during this quarter, they quietly secured long-term contracts of a similar scale with 2 other mega cloud giants. So they've effectively locked in their AI infrastructure revenue for the next several years. Plus, traditional telecom is bouncing back hard. The fiber-to-the-home run rate for large telecom providers is suddenly surging by 50%.
Part 3. Solar supply chain shift, speed, and setbacks.
This newly independent solar division is shaping up to be another massive growth engine. Their polysilicon business actually blew past its 20% operating margin target ahead of schedule, but aggressive growth comes with growing pains. What's crazy here is their speed. By leveraging government subsidies, Corning literally built the largest solar ingot and wafer plant in the United States in just 18 months. Bringing an entire solar supply chain back to US soil is an incredibly ambitious plan.
But rushing a build like that has a cost. To save time, they originally ran the factory on a temporary power and water system. Now they have to transition to a permanent power system in Q2, which means extending their maintenance downtime. So that transition creates a temporary $30 million expense, basically a 7-cent hit to their Q2 EPS. Management was very clear though, don't panic. This is a short-term, necessary setback. Once it restarts, profitability will sequentially improve quarter after quarter.
Section 4. Analyst Q&A Key Highlights.
Wall Street's Deep Dive.
This is always my favorite part of the earnings report, where analysts try to squeeze out the hidden details. An analyst from Credit Suisse asked the big question, with billions in long-term contracts, does Corning have to shoulder the massive cost of physically expanding fiber production all by themselves? The CEO said yes, they absolutely have to expand. But here's the genius of it. Corning is forcing the tech giants to share the expansion risk. Depending on the client, these agreements include guaranteed revenue, locked-in prices, and sometimes the customer directly funds the plant build. They also have a totally balanced approach. They don't care if Meta, Google, or Microsoft wins the AI race. Corning gets paid regardless. They aren't digging for gold, they are selling the shovels, and they are literally making the miners pay for the shovel factory.
And then, during a question from JP Morgan, the CEO highlighted a fundamental industry shift you absolutely need to grasp. In the past, data center expansion was horizontal scale-out, just buying more servers and spreading outwards. AI training is completely different. It requires vertical scale-up, which means extremely high-density network integration, like cutting-edge CPU and optical co-packaging. Corning made it very clear that supplying this specific high-end scale-up hardware is their newest and most explosive revenue driver.
Which brings us to our final section. Section 5, Future Outlook and Risks. What's next?
Looking at 2026 and beyond, the bull case is incredibly strong. Management estimates Q2 revenue will hit around $4.6 billion, up 14% year over year, with EPS expected to surge 25%. But what really got Wall Street excited was the update on their massive springboard growth plan. It was supposed to end in 2028, but customer demand is so overwhelming, they're officially extending it all the way to 2030. They'll drop more details on that during their May 6 Investor Day. And to support all this breathtaking growth, total capital expenditures for 2026 are projected to easily top $1.7 billion.
But to keep things completely objective, we have to talk about the bear case and the risks management specifically called out. First up, they warned that projected memory price hikes in 2026 could squeeze the overall hardware budgets of their big tech customers. Secondly, and this is a bit ironic, because Corning's stock price has surged so fast, they're taking a noticeable hit on operational expenses related to stock-based compensation for their employees. Definitely two metrics we need to keep a close eye on in the coming quarters.
So, that wraps up our deep dive into Corning. After looking at those insane numbers and their masterful risk-sharing strategy, I've got two questions for you, and I really want to hear your takes in the comments. Number one, do you think Corning's model of forcing AI tech giants to share the risk of factory expansion truly protects us shareholders in the long run? And number two, which U.S. stocks earnings report would you like me to unpack next? Let me know down in the comments. Thanks so much for hanging out with me today. Keep that passion for learning alive, and I'll catch you in the next one.